Hello, Keith Prather there with an NCM Automotive update. Let me share my screen and we'll jump over there. Okay, so this month we did get a little bit of improvement in the automotive demand index. We saw it move from 58.1 to 59. We don't have the August data in yet. Once we get the August data in, we can update the August index. It was a 1.5% higher month over month, but was still 1.5% lower year over year. Now remember, this is a demand index. It's a lot like a leading economic indicator in that it gives us an idea of what the environment will be over the next 6 months. And it's at least giving us hints of improvement and some sequential improvement, right? So we started to see a little bit of an uptick in May. That continued in June. We're starting to get a little more in July. Again, as I've said, if you watch the macroeconomic video, you'll see that we pinpointed in there that if the Fed drops interest rates by a quarter point in September, that would be a little bit of a catalyst to start helping consumers. And then we would definitely get more if we start to see them trim another quarter point in December. There's a lot of things moving around right now with regard to inflation, what we're seeing in the job market, what we're seeing with general economic activity, and things could change and dramatically swing over the next 2 to 3 months. And that can be very positive. It could also, kind of put us back into sort of the mode we've been in, where conditions are kind of just stalling out a little bit. And that's what we're concerned about, and that's what we're watching. Uh, for automotive, then we also watch the inventory to sales ratio, which is this orange line. And we still see as an industry, right? As an industry, we're still below where we were prior to the pandemic. We still see automotive inventories in general lower. And we've talked many times about this. Some of this could be that we just have brand new strategies coming out of the pandemic on how we manage inventory, how much we carry, how much we use the showrooms for literally just that showrooming. And then, we're ordering cars for customers as they come in and want to make a purchase. I do know that a lot of dealers, when I speak to them, a lot of dealers are telling me obviously that they are sitting heavier than they want to be. It seems like it's brand to brand and maybe even model to model, where we do still have some shortages and high demand. But right now, in general, we're still showing the industry lower than expectations. Again, what we don't know is whether we're setting just a new average, where this is the new normal coming out of the pandemic. From a sales perspective, though, we've had a lot of volatility, a lot of customers trying to get ahead of tariffs, a lot of customers really unsure about some of the future. And so we see these fits and spurts in sales, and we're getting a lot of volatility in the data. You see the range of change in the number of annual automotive sales that we get, and this time has been really wildly swinging. And some of it could be data anomalies. We'll see. This feels a little more like some of the swings we were getting in the early 2000s, and you were seeing that data anomaly, and you're seeing these fits and spurts early on in the decade, early in the 2000s. So we're getting a little bit of that same pattern here. It was a little more consistent and a little more, on average, staying in a nice tight range. We call that range bound prior to the pandemic. We're getting this volatility, but we're back still at levels, at 16.4 million units, near where we were prior to the pandemic. So it feels pretty good overall. We're nowhere near some of the troughs that we set, just coming out of the pandemic and then back where we were coming out of the Great Recession. So again, inventories are still about 35% lower against pre-pandemic levels. We don't know again if this is a new normal or where we're at, but generally, just in the last month, we got a pretty good sales number. Now, again, as I talk to a lot of dealers, they're telling me that they have since seen this decelerate and kind of move in the wrong direction. They're not getting as much foot traffic as they were getting. Some of that is back to school. We know it's normal cyclical types of behavior. Households are spending on kids and are realizing they're having to spend a little more than normal, and so that pulls them off the showroom floors. But hopefully, as we kind of get a little bit deeper into the fall, the job market will stabilize. We'll see some positive signs in the economy, and I think maybe you'll get a little more foot traffic and a little more optimistic shopping. And that's kind of what the automotive index overall was hinting at. So GDP, again, I talked about this earlier, but still ahead of expectations. And what we really like is the fact that consumer spending continues to be pretty strong. consumer spending is still running right at about 55 to 60% of GDP, and we saw it running at a pretty good rate overall. And the models for retail sales, then, which is generally going to help us understand what's going to happen in automotive, we do still see a positive sign here. So the forecast forward shows growth, kind of moderating a little bit through the end of the year, but then we accelerate in 2026. And that's what we like. You can really see it over here in the longer term chart where we get consistent growth after just a little bit of this flattening out period. We get that new acceleration, and next year we're expecting, based on this model, that we're going to see some record spending at a consumer level. And that's normally what we would get, but look at the gap between the long-term average for spending and where we are today and where the model shows us going. Still looks like we're going to be well above long-term averages, and that will help the automotive industry overall. This model has been performing well for us, almost 95% accuracy 6 months out, closer to 96% as we get in the 3 month period. But again, no downward bias here. There's very little risk here showing up on the model. Even in the downward side, it looks more like a more profound jogging sideways or kind of a flattening out instead of a deceleration or a decline in overall spending. So it's going to be money to go be had out there by consumers and picking up the share of wallet from the consumer spending. You just got to go find ways to capture it. So motor vehicles, though, we are showing it jogging sideways here, and there is a little bit of downside risk. Some of this is what we've been experiencing, I think, in the sector. We are hoping that we get some economic indicators coming up over the next couple of months as we get out of the tariff malaise and some of the tariff pressures, as we start to see consumers, kind of hit their stride, if you will, and build a little bit of momentum into the end of the year. I think the back end of this curve will lift and we'll see it improve over the next couple of months. It'll show a little more optimism, especially if the Federal Reserve trims interest rates. If they do that, then we will see the back end of this curve start to lift a little bit, and that'll be important. So we did talk about this in the macroeconomic version. If there is one metric to watch with disposable income, it's this one. We think it's growing a little bit closer to 2% in 2025, and that's very important. If you look prior to the pandemic and the prior Trump term, we grew at about 3.1%, and then we got a lot of noise in the pandemic, so we had it, it plummeted coming out of the pandemic itself, and then we got a nice little sharp rebound in 2023. You felt a little bit of that performance in 2024 when it hit almost 3%. We'd like to see this number, which is just the income left over at the end of the month after we take wages and we subtract housing and energy and food costs out of most households, what they have left over to generally spend on something like a big ticket purchase like an automobile. We'd like to see that above 2%. So again, late on Friday and over the weekend, we got a signal that maybe this is running about 2%, which would be a good signal if it continues at that range. And so hopefully it'll stay there, and then that will help fuel more foot traffic on showroom floors as we kind of move into the fall. The last couple of things, and we did talk about this in the macro view, I just want to touch on the fact that there's going to be differences. I've talked about this before. The lower end of the household range, households making less than 75,000 a year, you're still going to see some significant pressure in those households. They're not going to be hitting the dealership showroom floors as much as they were. They are really under pressure from both wages that are stagnant. We see wage growth here less than 2% in this income category, and they're getting hit by inflation that's running about 2.7%. So that gap where their wages are below inflation means every month they go a little further underwater. That's a problem. But in the upper end of the K, as long as you can build some sentiment and as long as we see some optimism build with those higher income earners, so households making more than 75,000 a year, I think you're going to see more traffic, and I think they're going to be your bigger buyer category. Just know that they're more educated and they're watching the news headlines a little bit more than maybe some of the other income categories. And so when they start to see the Federal Reserve move or they see some optimism in the stock market, that will affect how fast they go to showroom floors and really start shopping for new cars. So watch that. I think that's going to be the big story moving forward. So overall, what we've got is an economy that feels like it's flattening out. It's going to grow at about 1.5% this year, which is still okay. Normally, in an economy the size of the United States, we'd like to see it growing at about 2% or more. So it is underperforming a little bit. Again, Q3 is probably going to come in hotter than expectations, and we do think it's going to outperform where we think it's going to be. But Q4 has the potential to be a little bit weaker. Typically in Q4, we get a lot of benefits from inventory building activity as companies try to load up before we go into the Christmas season. And this year, we pre-built all those inventories. We got them in Q3, and so we think Q4 could come in sluggish. That's why for the full year, we're still looking at somewhere around 1.5%. And again, that's a pretty flat, sluggish headline. But there are other things. Again, there's tax incentives that are coming. We think the Federal Reserve will trim interest rates a little bit. We're just going to get those quarter point cuts maybe twice between now and the end of the year. And so we're going to watch for those signals, and that could really change, how much foot traffic we see on showroom floors. So we'll continue to watch. Again, I'll be back again, hopefully next month, and we will update you on all these factors next month. Look at the macro economy. We'll get a few more big key data points and some big news points between now and then. If you haven't, go check out the macroeconomic video this month. It's new. I do talk about tariffs. I'm talk about some of those things that we think could shape the market. A few of the items are included in this video. I wanted to be sure that if you only watched one video that we picked up on those news items, especially the disposable income, that's the key thing to watch. And again, we watched it tick up a little bit to 2%, but historically that's still running below where we'd like to see. We'd like to see it closer to 2.5 to 3% before we feel really good about, what's coming overall. So that's where we are. Again, I'd like to be optimistic, and I think I can be. There's just some concerns, some headwinds out there, and I know a lot of you are feeling them in the marketplace. So again, we're looking for recovery, and we're hoping to build some acceleration economically coming up. So, all right, again, we'll see you next month. All right, take care, everyone. Bye bye.